Good afternoon, everyone, and welcome to our 2025 Halftime Market Insights webinar. This afternoon, we'd like to share with you our thoughts on what happened over the past quarter, as well as what we're watching for the remainder of the year. Now, before getting started, the normal housekeeping items. Q&A. Please feel free to submit any questions that are on your mind using the Q&A feature. Our material should cover about 50 of the next 60 minutes, so we do have some time at the end to answer questions. So if there's something that's on your mind, please go ahead and submit that question. As usual, today's webinar will be recorded and uploaded to our YouTube channel for future consumption. I'm Greg Leonberger. I'm the Director of Research here and the usual host for this webinar series. Joining me today are our lead asset class analysts. For fixed income, we have Frank Valli and James Torgerson. For U.S. equities and non-U.S. equities, we have Catherine Hillier and David Hernandez. Then on the alternative side of things, Evan Fraser will cover hedge funds. Dennis Yu will review real estate and infrastructure. And for our private markets coverage, we have Amy Miller covering private equity and Chad Schaefer covering private credit. As we typically do, we'll start with the U.S. economy, and there's a lot of angles we could cover to the economy, but we're going to start with the one big beautiful bill, which was signed into law on July 4th by President Trump. One of the big platforms of this bill is that it will boost economic growth. And probably not surprisingly, there are varying predictions of how much this is going to add to GDP. What stands out is the White House Council of Economic Advisors. They have the most elevated expectations of what this will do to growth. But it's important to note that all of these projections across the different organizations do predict positive GDP growth in the coming years. One of the other expected results of the bill is an increase to the deficit of about $3 trillion over the next decade. The sources of this increase to the deficit are shown here. And clearly, this is a long-term number. But we've seen some markets, particularly the fixed income market, react to the growth of the deficit as reflected by longer-term interest rates. And Frank will cover that in his section. Of course, a lot of other things happened over the quarter as well. I think most notable is the Liberation Day announcement of tariffs and then the gyrations around what those tariffs will ultimately look like. And where we sit today, there's still a lot of uncertainty about that tariff outlook looking into the rest of the year. And we've coupled that with the dampened investor confidence and lower business investment. It's probably not surprising that global growth expectations across countries across the world more or less have taken a step down. Not a significant step down, but have trended a bit lower since the last time we shared these expectations with everyone. And the good news, of course, I think this is a glass half full look that the GDP growth is expected to be positive across all these regions, but the trend is slightly downwards from what those projections were 6 months ago. So with that as kind of the backdrop to capital markets, well, we always start with the fixed income. And there's a lot of correlation between the U.S. economy and economic policy with interest rates and what that does to fixed income. So Frank's going to cover the investment grade side of things, and James is going to cover the below investment grade side of things. So Frank, we'll tee you up first to cover the investment grade of fixed income.
Thanks, Greg. After a volatile start to the quarter, fixed income posted solid returns. The aggregate was up 1.2%, and high yield was up 3.5%. The star within fixed income was local EMD, which had a strong quarter on dollar weakness. The one area that was soft within fixed income was longer dated securities. A lot of that was due to higher back-end rates. So the Treasury curve has gotten a lot steeper over the last year. First, front-end rates fell as the Fed cut rates. Lately, it has come from higher rates on the long end. This has created a term premium as the longer dated rates has risen. For a few reasons. The first is on inflation fears. The impacts of tariffs could cause higher inflation in the future. The other two are related to the continued budget deficit and rising debt levels. This is creating an extra premium at the long end of the curve where investors are able to get additional income by moving out. Fixed income yields remain elevated and generally above historical averages. The aggregate is at 4.5%. And some satellite, more offensive areas within fixed income have a 7.5% to 8% yield to worst. Looking forward, with a 4.5% starting yield, fixed income remains an attractive area. Under most scenarios, fixed income will provide positive total returns over the next year. I'll hand it over to James now to cover some of the credit markets.
So from a spread perspective, if you would have fallen asleep at the end of March, woken up at the end of June, you would think nothing significant happened in the second quarter based on where spread levels finished. After a post-Liberation Day blowout, credit spreads swiftly tightened back to near all-time tight levels. So if you blinked in April, you missed pretty much any value that was available. Spread valuations are once again very rich. So looking at high yield and loan spread and yield premiums. These compressed a lot in the first quarter, but the differential between high yield and loan spreads and yields widened once again in the second quarter. Loans have continued to out yield and traded higher spreads than high yield, but this premium reflects some elevated credit risks that are emerging in the lowest quality part of this market. So reflecting some of that trend, let's take a look at leverage finance and performance by rating. So you're starting to see performance dispersion based on the credit ratings in leverage finance, particularly in the leverage loan space. So the performance of lower rated issues had already started to diverge in the first quarter, but the volatility that we saw in April really accelerated this trend. Prolonged higher interest rates and increasingly uncertain economic and policy outlook is starting to really weigh on the weakest companies, as you can see here. And after a multi-year run of outperformance for triple Cs relative to single Bs and double Bs, being higher in quality in lower quality markets is finally starting to pay off for investors. So moving on to defaults. So let's take a look at the outlook here. The default picture is not materially changed, and recent default trends have actually slowed slightly. Fundamentals continue to remain resilient across credit markets. However, forward-looking default projections have moved slightly higher. High-yield defaults are expected to remain below long-term averages, while loans will continue to be slightly above. It is important to note here, though, that a large amount of the elevated defaults you see in the loan data here are driven by liability management exercises. We've discussed these on past webinars, but these are not by definition defaults, and the inclusion skews these rates slightly higher. So Frank mentioned that local EMD has been a star performer this year, and that is definitely the case. So this is an often ignored asset class and an often volatile asset class, but it has had a banner year and been the best performing segment across fixed income. The reason for this is that local market EMD returns are often driven by the direction of the dollar. As the dollar has been meaningfully weakened in the first half of this year, local EMD has benefited quite a bit from this, as foreign investors are instead investing their marginal dollar in home markets. While local EMD looks good now, it is important to note that the long-term risk-adjusted returns here have been poor relative to other segments of fixed income and has shown very elevated volatility. So let's finish up with some opportunity and risks here in fixed income. You've heard us say this for years now, but bonds are still back. Higher yields, increased yields continues to provide income cushion for any spread widening or volatility we may see. As Frank mentioned, there is return of the term premium, so you're finally getting paid to actually go out farther onto the yield curve. And as we mentioned already, corporate fundamentals continue to remain strong. And obviously, there are risks. Stagflation continues to be a risk. Coming inflation and growth data will be very important to monitor. And as I just mentioned, spread valuations are once again rich. There's not as much value from a spread perspective. And then ad nauseum, there's a lot of wild cards, whether that's tariff policy, the fiscal deficit, geopolitical threats, and now even the specter of possibly a fight between our Fed chair and president being fired. So there's a lot of opportunities, but there's also risks that you need to monitor.
Thanks, James. I think you said it best, the opening comments from your section, that if you blinked in April and slept through the month, you really wouldn't know what happened in terms of where we are today versus where we are at the beginning of the quarter. The yields are still high, spreads are still tight, and then there are wild cards hovering in the background, which can impact the market on any given day. Let's move now to U.S. equities. And Catherine, a busy quarter for equities. Let us know what you saw.
Yeah, thanks, Greg. So following an underwhelming first quarter, the second quarter was anything but calm for U.S. equities as volatility peaked in early April. As Greg and James have referred to, much of the uncertainty was driven by tariff policy, as new tariffs announced on Liberation Day on April 2nd were worse than feared. Markets extended their losses from the first quarter as the Russell 2000 index and the tech-heavy NASDAQ entered bear market territory, with both indices more than 20% off their previous highs. This volatility was short-lived, however, as a tariff pause on April 9th brought one of the S&P 500's best days historically, as the index rose 9.5%. As the quarter progressed, growth equities reasserted their dominance, propelling the S&P 500 to the strongest May performance in 35 years. During the quarter, the Russell 1000 growth bested the Russell 1000 value by over 14%. Another historic statistic, as this represents one of the widest quarterly performance dispersions for these indices. Given these dynamics, probably unsurprisingly, markets were driven by a trend that has been all too familiar since 2022, as the Magnificent Seven contributed nearly 60% of the S&P 500 return in the quarter. Now, conversely, following 10 quarters of negative earnings growth, the more economically sensitive small cap equities struggled relative to their large cap peers, another all too familiar trend, unfortunately. The Russell 2000 gained 8.5% in the second quarter, but trailed the 10.9% return for the S&P 500. This was also not enough to overcome a very challenged first quarter, as the Russell 2000 posted a 1.8% decline year to date, making it one of the worst performing asset classes more broadly. Although we don't commonly talk about mid-caps, it is worth noting here because the Russell Mid-Cap Growth Index was the strongest performing asset class, both in the second quarter and on a year-to-date basis. Similar to the concentration seen in large cap indices, the Russell Mid-Cap Growth Index was largely driven by a small number of companies, some you may have heard of, Palantir and AppLovin, as concentration also rose to historic levels for the Russell Mid-Cap Growth Index. Now, looking at sector performance, markets saw a near reversal from what we saw in the first quarter, when value-oriented sectors, those including energy, financials, real estate, and utilities, led to begin the year. As energy gave back some of its gains and real estate ended the second quarter flat, growth-oriented sectors rallied in a more risk-on environment. As the Magnificent Seven outperformed, as we mentioned, unsurprisingly, the technology, communication services, and consumer discretionary sectors led in the second quarter. As I mentioned earlier, although market volatility in the first few trading days of April, this was short-lived. Following this volatility, the S&P 500 posted a new all-time high to close the second quarter as a resilient U.S. economy and stable earnings growth continued to provide support to large cap equities. As shown here, looking at the last 5 times, the S&P 500 fell over 15%. 2025 staged the fastest rebound off those lows, as the S&P 500 ended the quarter 26% off its April 8th low. Now, investors may be concerned as they consider investing in the market at all-time highs, but an analysis done by JP Morgan showed that investing in the market at all-time highs can actually generate stronger returns over the next 1 to 5 years compared to investing on any other day. As I mentioned earlier as well, the Magnificent Seven contributed nearly 60% of the S&P 500 return in the quarter. Now, although this cohort of companies has collectively been credited with driving market performance in recent years, 2 companies, NVIDIA and Microsoft, have set themselves apart in 2025 as these companies accounted for the majority of those market gains. But what has caused the dominant market leadership for these companies? As shown on this slide, these companies have contributed most of the earnings growth for the S&P 500 in the past 2 years, and ultimately earnings will drive performance. So this leadership really does support the strength in these companies. Thinking back now to the previous slide, if earnings growth is able to persist, this may support continued market strength despite the all-time highs we've recently seen. It is also worth noting, though, that market concentration reapproached all-time highs at the end of the second quarter as well. So this is something to continue to be aware of, and we've had as one of our considerations for several quarters on these webinars. Thinking beyond the Magnificent Seven, one of the hopes we have also talked about in recent quarters is the potential for market breadth to reemerge, as this may also support continued market strength for U.S. equities. While we have seen signs of improving market breadth as industrials and financials, as well as small caps, all performed well in June, this trend has not asserted itself consistently. This slide does suggest, though, that earnings growth among the rest of the companies in the S&P 500 has improved since the end of 2023, and this may be positive as we look into the future for U.S. equities. I believe David will touch on the performance of international equity markets and the impact of currency on this performance, but on this slide we break down the equity index returns across multiple regions. In line with what we saw on the previous slide, earnings growth propelled the large cap U.S. equity market higher as valuations contracted only slightly. Within U.S. equities, valuation contraction was more pronounced in the Russell 3000, which includes the more challenged small cap equity market. Now, looking overseas, excess returns generated in Europe, Japan, and China were largely a result of a combination of currency and valuation expansion, And this outperformance seen in international equities, however, may not be as sustainable if earnings growth remains relatively modest in these regions. We take a look at valuations each quarter on this webinar, and much of the story remains the same. The U.S. equity market is expensive, especially relative to international equities, and small cap equities remain relatively more attractive than their large cap peers. In fact, the valuation gap between large and small cap equities is historically wide currently. This quarter, I may add that although large cap equities remain expensive relative to their own history, absolute valuations have come in modestly, and continuing economic resilience and strong earnings growth may support positive returns for large caps despite their expensive valuations. Additionally, although small cap valuations continue to be attractive, their lackluster earnings and policy uncertainty remain headwinds for the asset class. So attractive valuations will likely not be enough to drive a persistent rebound despite the brief recovery we saw in June. And thinking about risks and opportunities, I believe we still may be tilted a little bit more towards the risk side. Namely, stagflation remains a possibility, as James mentioned, and market concentration again at near historic levels, as I mentioned earlier. From an opportunities perspective, although a slowdown in economic growth is anticipated and market volatility is likely to persist as the impacts of trade policy do remain unseen, earnings growth and the potential for deregulation may continue to support U.S. equity market performance through the end of the year. And although there are challenges to U.S. exceptionalism and a weakening U.S. dollar does support the international equity markets, innovation and technological advancements in the U.S. may continue to provide the structural tailwinds long-term for the U.S. equity market.
Thanks, Catherine. The concentration risk theme is something that we've shared a lot over the last couple of years, but it bears repeating that as the Mag 7 goes, so go large cap indices. So it's critical to keep an eye on what those earnings reports look like versus expectations, because that will undoubtedly have an effect on markets. So that's the U.S. side of things. And David, non-U.S. equities versus U.S. equities are off to a really nice start through the first half of the year. So I want to hear your thoughts around that, as well as what you're watching for the last 6 months of the year.
Yes, very nice start. And after a strong first quarter, non-U.S. equities pushed higher, and the major benchmarks have already generated double-digit returns this year. You've got the EFI Small Cap Index, which returned nearly 21%. It's followed by the EFI Large Cap Index, up about 19%. Emerging markets up 15%. And I think that these numbers, this is a bit of an unexpected outcome. If you remember at the start of 2025, there were some significant risks to non-U.S. equities, including Trump's policies, both in terms of trade as well as policies that would be supportive of a strong dollar and strong U.S. economic growth. You also had some question marks about potential growth, economic growth in non-U.S. equity markets. Now, there are certainly some positives and some bright spots in non-U.S. equities that help bring some counterbalance to those risks. But a 20% return in the first 6 months, I don't think was on anyone's bingo cards to start this year. So I think it's a fair question to ask, how did we get here? First, if you look at countries, there wasn't a single country that's driving this outperformance of non-U.S. equities. It's broad-based. And so if we look at the top 13 countries from a market capitalization perspective and using a global equity benchmark, 11 of those countries have double-digit returns, and all 11 of those countries are outperforming the United States. So very broad performance on a country basis, and that same thing applies when you look at it from a regional basis. It's not regional concentration. You've got Europe, Asia, Latin America, South Africa. These regions are all doing well. Now, one of the major reasons why you see this broad performance is because of currency. As has been mentioned several times, the US dollar has been weak. And that's really despite having higher growth, higher interest rates in the US relative to other developed markets, and higher economic growth rates relative to other developed markets. And the dollar has experienced a historical period of weakness. So the DXY index, which represents the dollar performance versus a basket of currencies, that index had its second worst 6-month start to a year, its first worst since 1973, and it's down 11% year to date. Now, in our 2025 preview, we did note that the dollar was trading at 30-year highs. It had a very strong run, and we noted that that would make it susceptible to pullbacks. But in terms of the 11% number loss, I think that is surprising, not necessarily in terms of directionality, but more in terms of the magnitude of loss there. Now, that currency movement, that's had a positive impact for non-U.S. equity returns. Currencies accounted for, on an absolute basis, 4.5% of emerging markets' 15.3% year-to-date return. And it's had an even bigger impact on developed markets, where it accounts for, on an absolute basis, 11% of the 19% return. So that's more than 50% of the return this year. Now, this contrasts with 2024, where we saw a much different story. Currencies detracted across non-U.S. equities. On a regional basis, currency has been especially additive in Europe, where the euro is up 13.8% relative to the US dollar this year. Now, that boost from the euro has helped European stocks finally beat US stocks, and it did a beat by a record amount this year. So if we look at performance differences between the Euro Stoxx 600 and the S&P 500 in 6-month chunks, we go back 25 years, and this is the largest outperformance that we've seen from Euro 600 over the S&P 500, and that performance difference this year through June is 17.8%. I think another interesting thing in this chart, if you look at these numbers, U.S. equities, S&P 500 has had an incredible run between 2018 and 2024, but you're seeing the Europe come back here and to start 2025. Now, within Europe, you've seen a lot of standout performers. If you think about it from a stock perspective or industry perspective, banks within financials have done exceptionally well. Defense companies have done exceptionally well. We talked about defense companies in the first quarter webinar and talked about the expectations around increased defense spending from Europe and how that's going to have some positive momentum. So that has impacted European markets, but you're also seeing broad participation. It's not just those two industries. If you look at sector performance across Europe, you see positive numbers. You see some double-digit numbers from other sectors outside of financials as well as industrials. Now, it hasn't been all good in the non-U.S. neighborhood. Broadly, non-U.S. equities have shrugged off tariff concerns or policy concerns concerning President Trump, but there have been pockets of underperformance. For example, automakers have struggled this year, particularly in Japan. And if you think about Japan as a country or auto as an industry, those are areas of the market that are in the crosshairs for President Trump. You go back to April 1st, and there was a 25% tariff placed on auto, and President Trump has promised that there will be some additional tariffs placed on Japan, potentially on August 1st. So President Trump's policies, they are impacting non-U.S. equities, even though you're seeing this very strong performance, and it's impacting it in pockets. And I think you'll likely continue to see uncertainty around President Trump's policies. So that is a risk that we see for the rest of the year. Now, another key risk that we're monitoring is valuation. Most investors know, it's well known, it's in a lot of headlines, the S&P 500 trades at historical high valuations. Non-U.S. equities are cheaper than U.S. equities. That's all true. But while non-U.S. equities are less expensive than the S&P 500, this year's strong performance from non-U.S. equity large caps has pushed multiples higher. So if you look at valuations at the start of 2025, these metrics were close to average, around the 55th percentile. And through the first half, with the strong run in performance, we've seen multiples expand towards that 75th percentile. Catherine had a nice chart on that broke it out by region. This is looking at it more broad base across non-U.S. equities. And the concern here is that as multiples expand, and especially as you get into that top quartile, it removes any cushion should there be a bout of volatility, some sell-off. It removes potential downside from that should that happen. Now, one of the things I'll note is that non-U.S. small cap, or EAFE small cap, I think is an interesting asset class. There, the valuations aren't as high. So small caps trade cheaper than large caps, both in the non-U.S. market as well as domestically. And if we see some improved economic growth, particularly in Europe, if you see some further rate cuts in Europe, that could be beneficial for this asset class. So I think that's an asset class to keep an eye on over the next couple of quarters. So let's wrap up with the opportunities and risk for non-U.S. equities. Talked a little bit about Europe defense build out. We mentioned that in the first quarter. Second quarter, there was some additional news. In June, NATO came out and said that the countries were going to have a 5% target in terms of spending to GDP that the countries would be expected to adhere to. The target is for that to get accomplished by 2035, so that has some potential to build momentum over medium and long term. Also, from an opportunity perspective, inflation in the Eurozone has moderated, which gives opportunity for them to cut interest rates, which would be pro-economic growth. And I didn't mention this, but there is a positive earnings outlook. When you looked at the composite of returns, a lot of that was from currency and multiple expansion, with very little coming from positive earnings. But the rest of the year, earnings are expected to be positive, and the outlook for 2026, both for developed as well as emerging markets, is double-digit earnings growth. So should that come to fruition, that would be very supportive. From a risk perspective, mentioned policy uncertainty. Japan, the uncertainty around the trade policy, but also from an economic perspective, that's a country that relies heavily on exports and have revenues exposed to the United States. So trade can definitely influence that market as well as that economy. And then I also mentioned multiple expansion, removing some of the cushions should we see a sell-off in global equities.
David, it's been more than a decade since non-U.S. equities broadly outperformed U.S. equities, and perhaps this is the year. But one of the things to watch carefully, as you just touched upon in the risk section, is the multiple expansion, and we really need to see positive earnings out of the indices and companies meeting their marks and expectations in order for the market to hold for the remainder of the year. All right, let's move now to the alternatives piece of this afternoon's webinar, and we're going to lead it off with hedge funds. And Evan, hedge funds have really delivered on their goals over the last couple of years of preserving principal in down markets and then providing upside potential when markets are going up. So what do you see over the first half of the year, and then what are you watching for during the rest of 2025?
Yeah, well, you took the words right out of my mouth, Greg. You're right. 2Q, we certainly saw continued strong performance out of most hedge fund strategy types. That's kind of building on the gains that we saw in Q1 and in 2024. I would say the standout in 2Q was the equity hedge index, so equity-oriented hedge funds. They were up more than 7.5%. That's the strongest quarter for that index in more than 4 years and brings the year-to-date return for that index to more than 6%. That's in line with the S&P 500. And I think that's noteworthy because most equity hedge funds are supposed to act as the name would imply, sort of market hedges. We rarely see kind of full upside participation from these types of strategies during positive markets. And so the fact that this index is keeping pace with the broad market this year, I think speaks to the ability of managers to protect capital, like you said, during the drawdown that we saw in April, and then position themselves favorably for the eventual market rebound. I think a few other things to call out on this slide would be merger arb and event driven. Both of those indices are up more than 5% for the year. We've seen a couple of high-profile deal closures this year, and in 2Q specifically, that have been tailwinds to those spaces. So Nippon Steel, for example, that their takeover of U.S. Steel finally got over the finish line in 2Q after a lot of highly publicized back and forth. You saw Capital One's acquisition of Discover go through in 2Q, so certainly some positive developments in those spaces. You'll notice global macro, which actually did pretty well in 2024, was the big laggard. This year, it's down about 1.3% since the start of 2025. The big chunk of that negative return came early in 2Q amid the Liberation Day induced market craziness that we saw. I think a lot of those funds were caught offside due to their U.S. exposure across currency. We detailed the dollar depreciation, so currency, rates, some equity exposure, and they really haven't been able to make up those losses just yet. That's sort of the risk you run with these types of strategies. And then last, the put right index, we talk about this one a lot, basically flat for the year after posting a gain of about 2.5% in 2Q. Put right doesn't do particularly well when markets are moving sharply in either direction, so not too surprising to see more muted performance from this index in 2025, given some of the swings that we've seen so far this year. So I talked about really strong performance from equity-oriented hedge funds. A big reason for this would be the long alpha in particular that they've been able to generate. So we can see here that the top 50 hedge funds long positions have outperformed the S&P 500 by around 900 basis points since the start of the year. And June in particular was the strongest month of global long alpha since January of 2024, according to Morgan Stanley. And I think this recent stretch of positive long alpha generation is especially notable given just how underwater long performance was as recently as April, when that basket of popular hedge fund longs was trailing the S&P on a year-to-date basis by nearly 300 basis points. And while we haven't seen that kind of strong alpha generation on the short side this year, this long alpha dynamic is encouraging because it speaks to the fact that hedge funds were able to, again, position themselves to be highly opportunistic during the market sell-off in early 2Q by exploiting mispricings and putting on positions that would allow them to take advantage of the market recovery that we've seen over the last couple of months. So I believe we had this slide in last quarter's webinar, and the headline kind of says it all here. So 3 months ago, spot VIX was above 30, and I think it may have even gotten above 50 or so at one point in early April. But since then, we've seen significant moderation in volatility such that VIX is now back down below the 16, 17 level, which is below kind of long-term averages. And that's certainly good for equity markets. More stability, obviously, positive sentiment have kind of fueled that comeback that we've seen over the last couple of months. For hedge funds specifically, I would say this dynamic is a little more mixed, at least from a relative performance perspective. So higher levels of volatility typically lead to outperformance of the broad market by most hedge fund strategy types. So equity hedge funds, for instance, tend to outperform the S&P by about 1% in months when the VIX is a standard deviation above its long-term average. And then the opposite is true. So lower levels of volatility tend to lead to underperformance of hedge funds of the broad market. So should the current volatility environment persist, we should expect more muted performance from hedge funds, at least on a relative basis going forward. So Dave detailed this dynamic very eloquently a moment ago. The dollar has certainly been a notable currency to watch this year, down more than 10% since the start of the year. I think a couple of reasons for this movement. So first, U.S. trade policy uncertainty, our federal deficit, concerns around that, the Moody's downgrade of U.S. credit, and the big, beautiful bill that just got passed, which is expected to add around $3 trillion to the deficit, and then expectations of rate cuts from the Fed in the coming months. All of these factors have contributed to dollar weakness. And you can see here that dollar bearishness across hedge funds is now at a level that we haven't seen in years, indicating that many hedge fund managers feel as though the dollar may be poised to drop even further. So certainly something to keep a close eye on going forward, especially given the extent to which currency and rate movements impact not just hedge fund returns, but equity and fixed income returns as well. So when it comes to the risks facing hedge funds, we discussed the potential for lower market volatility going forward. There's also the risk of, again, these more kind of sharp currency movements, sort of a double-edged sword. Could be good for hedge funds that are positioned correctly, but as we saw in April, those currency markets, commodity markets, they can be very difficult to forecast sometimes, less well-defined, I would say, than equities or fixed income. And then I mentioned some of the transactions, those deals that closed in 2Q. But I want to be clear, if the current pace of deal making continues, 2025 is going to see the lowest volume of deals in over a decade. And that's going to make it harder for merger arb strategies to source and execute on potential portfolio opportunities. And then on the opportunities front, so we do expect interest rates to remain elevated, at least for the next couple of months. That should benefit volatility risk premium managers, those put right strategies, and equity long short funds in particular, all else equal. Higher dispersion, another potential opportunity for hedge funds. So that's sort of across equity and credit markets. That higher dispersion should benefit managers with more of an active focus. And we're still hearing from hedge fund managers about dislocations that are persisting from the volatility that we saw in April, and funds with kind of more of a relative value focus should be able to capitalize on those in the months ahead. So all in all, again, very strong first half and second quarter for most hedge fund strategies, especially on the equity side. And here's hoping that continues into the second half of this year and beyond. And with that, Greg, I'll turn it back over to you.
Thanks, Evan. It's worth repeating too that hedge funds are able to they benefit from a really wide range of mandate of what they can invest in and what kind of strategies they can utilize. So I'm curious to see if they can maintain their momentum for the first half of the year, given all the variables going into the second half of the year. Okay, so let's move to real assets now. And Dennis is going to go through both real estate and infrastructure. And Dennis, why don't you lead us off with real estate and then go right into infrastructure?
Absolutely. So for real estate, in terms of the performance, as a reminder, private real estate is reported on a lagged basis. So for the first quarter of this year, the NFI Odyssey Index achieved a total gross return of 1.1%. This was driven by 1% income and 0.1% appreciation. We also just received the preliminary second quarter report from Equities, showing a total growth return of 1%. Notably, all sectors generated positive return in the first quarter, including office. In addition, we also see first quarter transaction activity up about 19% across all sectors as demand remains strong to start 25. Overall, data definitely shows that historical valuation adjustment have paved the way for a prolonged phase of strong returns within real estate. On top of increasing deal flow, this slide highlights the sharp decline in construction activity in commercial real estate. On the apartment side, new start have fallen by more than 70% from peak levels, and numbers of units under construction is also in rapid decline. A similar trend is observed on the industrial side, where supply are shrinking after a record wave of development in 22. This constrained supply situation is expected to be a key tailwind for rent growth going forward, especially in sectors like residential and industrial that continue to benefit from healthy demand fundamentals. On the demand side, this chart underscores the recovery in multifamily demand as net absorption in the first quarter of 25 reached the highest level for any first quarter period in more than 25 years. After a muted period, demand has rebounded, outpacing new supply in recent quarters. More importantly, this surge in absorption coincided with the decline in construction level, reinforcing a very healthy supply-demand dynamic, which should support rent growth across many markets, especially in areas with limited pipeline activity. In terms of net operating income growth by sectors, alternative sectors are expected to drive near-term income growth. Sectors like senior housing and data centers are projected to deliver the highest NOI growth through 29, reflecting strong demand drivers and favorable supply dynamics. Even though traditional sectors such as industrial and apartments showing moderated growth projections, but their long-term outlook remains steady, suggesting they continue to be the foundation of diversified real estate investments. To summarize real estate here, the current market offers compelling opportunities in non-core and distressed segments where dislocations and constrained financing has created attractive entry points for value-added and opportunistic strategies. Meanwhile, alternatives present strong fundamentals and diversification benefits. On the risk side, the office sector remains challenged by ongoing lease and valuation pressures. Construction costs are rising due to proposed tariffs and labor shortages. And lastly, the rising 10-year Treasury rate continued to be the headwind for valuations as borrowing remains expensive. Moving on to infrastructure, we see a 3.1% quarterly return for private infrastructure with a solid 7.8% return over 1 year and consistent performance over even longer periods. This indicates steady and reliable performance for private infrastructure, making it a very attractive option for investors seeking stable contractual revenue stream tied to inflation. This chart here highlights a strong macroeconomic insulation for core private infrastructure relative to other asset classes. Within among the lowest total macro sensitivities, core infrastructure offers resilience through market cycles. Compared to other asset classes here, infrastructure demonstrates significantly lower exposure to macro factors like interest rate and inflation. This reduced the beta, preserved downside protection, especially during economic stress. As a result, core infrastructure continued to play a very valuable role in portfolio allocation, delivering strong long duration income generating exposure with limited correlation to broader market risks. For particular infrastructure theme, we realize this power demand in the US is rising significantly situation, especially with the growth of digital assets. As shown in the chart here, power demand growth is tracking closer to, or in some cases, actually outpacing GDP growth. It is fair to say that infrastructure investment increasing tapping to structural growth, especially in energy and renewable sector. Lastly, the secondary infrastructure also has seen significant growth, with deal flow increasing at 24% annually over the past decade. LP-led transactions remain the dominant driver there, but GP-led deals also gain momentum in recent years as GPs seek liquidity solutions in a very challenged exit environment. Additionally, on the right side, we see a clear valuation gap between SMID and the large cap deals. SMID infrastructure transactions are trading at a meaningfully discount, roughly 23% lower multiples compared to large cap transactions. This dynamic presents very unique opportunity for investors to access high quality assets at a very attractive pricing. To wrap up on infrastructure here, the current market environment presents compelling opportunities in secondary market, where institutional demand and liquidity needs are unlocking access to high quality cash generating assets at a scale. Additionally, surging power demand driven by digital assets is creating long-term investment potential in critical infrastructure assets. On the risk side, assets linked to GDP like ports and airports remain exposed to macro uncertainty. Selectivity is also the key here, as asset quality, location, and operational execution can significantly impact outcome across infrastructure sectors. With that, back to Greg.
Thanks, Dennis. And for core real estate, the worst appears to be behind us with going on now 3 quarters of positive returns, which is a great trend. And then infrastructure, the story is really the same. It continues to be a growing part of institutional portfolios, really is laid out by the reasons that Dennis shared with us here today, as in previous webinars as well. Now, private markets, private equity and private credit. Amy, we'll let you cover private equity, and then Chad, I'll throw it to you for private credit.
Great, thanks, Greg. Let's start with performance for private equity and venture capital. And as a reminder to everybody listening, performance is lagged and is as of the first quarter. In the first quarter of 2025, global and U.S. venture, as well as U.S. expansion, outperformed over the short term. Over the mid and long term, U.S. small buyout, which we define as funds with $1 billion or less in capital commitments, has continued to shine. Generally, private equity is still outperforming the public markets on a long-term basis, with the exception of the global expansion stage. With respect to overall deal activity, while M&A activity started positive in the first quarter relative to the same quarter in 2024, we did see both an uptick in deal value and volume. However, overall activity has been choppy over the past several quarters. It is important to call out the fact that there is some seasonality to consider when identifying these trends. Looking at private equity activity specifically, it has been a little bit more consistent than the overall M&A market, showing positive trends in both volume and value in each of the last 4 quarters relative to the same period in the prior year. 2Q is trending positively, but at a much more tempered pace after the tariff announcements and before the big, beautiful bill passed in early 3Q. For private equity exit activity, you'll all be happy to hear that private equity exit activity did also pick up in the second half of 2024, and that trend has continued through the first quarter of 2025. Preliminary 2Q numbers showed continued positive momentum, and we're hopeful that with the passing of the bill in July and that the pro-growth expectations will support further activity across the asset class. The exit to investment ratio remained relatively flat from 2024 and remains below the 10-year average of 0.47x. However, as the graph does show, this trend started over 10 years ago. Hold periods. Generally, since 2018, private equity managers have been holding assets for longer. With the rise in interest rates, this comes as no surprise, as low interest debt will no longer be the catalyst for trades. A-plus assets where key operational improvements have been made will continue to dominate when an asset is ready to be sold, which takes a bit more time to execute than simply a recapitalization. On venture capital valuations, recall my comments on the two of the outperformers for the quarter, U.S. venture and expansion stage, which has also been the case on a rolling one-year basis. We can see these trends in the display graph, which with much of the capital flow and valuation trends within venture have been driven by investments in artificial intelligence and machine learning. While that segment represents 33% of deal count, those transactions account for over 70% of deal value thus far in 2025. More on the implications there in a moment. With venture exit activity, for venture managers in the U.S., this remains muted relative to 2021, which was clearly an anomaly in the past 10 plus years. The 2024 marked the first year of positive growth since 2021 in both exit count and value. Whether that trajectory continues relies in large part on the IPO market. From a global perspective, IPO proceeds increased by 17% in the first half of 2025 relative to the same period in 2024. That increased from 49.6 billion in the first half of 2024 to 58.2 billion, and the number of IPOs also increased for the period. From an overall opportunities and risk perspective, uncertainty continues to create opportunities for managers with dry powder, but it does put fundraising at risk for those looking to come back to market in the near term. Artificial intelligence and machine learning will continue to dominate the VC asset class. This could also pose as a risk, as it could be an indicator of a bubble in the segment with too many startups chasing the same strategy, which may be inflating valuations. Exits continue to be top of mind for investors as aged assets remain in their portfolios, though as mentioned, the last 4 quarters are indicating positive momentum with exits. The long-term impact, this is a key theme throughout the webinar today, the long-term impacts of tariffs remain a question mark. However, many businesses that diversified their supply chain and customer base after COVID, and then the subsequent disruption in the overseas supply chain is creating somewhat of a buffer. In addition, the tariff uncertainty has also made several businesses pause on capital investment, which may create a higher risk for a recession in the near term. And this will be a piece of the balancing act as we move into the second half of the year. Back to you, Greg.
Thanks, Amy. It's some really important points to remind everyone here that private equity is subject to specific market factors, specific industry factors, but broad economic factors as well. That all plays into the outlook for private equity. And Amy did a really nice job there highlighting the main ones to watch as the year plays out. All right, Chad, last, certainly not least, private credit. What are you seeing? What have you seen? And what are you expecting?
Thanks, Greg. Just to start, I have the usual disclaimer here that private credit returns are lagged. So this data is through the first quarter. That being said, the quarter represented another strong period for direct lending, particularly when you look on a relative basis versus public credit markets. Middle market direct lending delivered just over 2% for the quarter, outperforming leveraged loans and high yield by 150 basis points and 110 basis points respectively. Now, notably, this period doesn't capture any of the short-term vol we saw with regard to tariff impacts post-Liberation Day. But given that liquid credit markets were positive for the quarter, I would say we wouldn't expect a significant amount of impact in Q2 for private credit. If you look further out on trailing returns, we've seen direct lending, private credit generally consistently outperform liquid credit markets by 200 to 400 basis points. And that's ultimately a benefit from the relative spread premium versus public credit markets and generally low losses over time. To highlight this a little bit, we can look at the breakdown of quarterly returns for the index. While all-in returns have ticked lower from peak performance in mid-2024, as you can see on the chart, as a result of lower base rates and spread tightening, the light blue bars do highlight the consistency of returns driven by the attractive all-in yields you can generate in this asset class. Now, additionally, you can see from the lack of purple and green bars more recently on this chart, losses have been pretty muted and well below average since the period where we saw a little bit of a pickup of unrealized losses in 2022. Again, more recently, we haven't seen that pick up materially, and annualized realized losses remain well below average The trailing 1-year period realized loss rate is about 63 basis points, and that's below the long-term average at around 1%. Now, turning to relative spreads versus liquid leverage loans, you can see that direct lending continues to offer a premium somewhere in the 140 basis point range. Now, that's lower from the wides we saw in 2022 and 2023, and we've also seen a compression in spreads from both markets, private and public. But that relative premium around 140, 150 basis points still offers a relatively attractive return premium, especially when you compare like-for-like credit. And in some cases, the quality or the downside protection, I would argue, in private credit is still superior. If you look at origination, we entered 2025 with expectations that we'd see a pretty large surge in M&A activity in private markets. This would benefit both direct lending and leverage loans. We saw an uptick in Q1. Amy mentioned some of the uptick in exits, but just given the general uncertainty around tariffs and how that'll affect certain parts of the market, by and large, the massive uptick in M&A hasn't really materialized. Recent guidance suggests maybe that comes sometime in 2026. I'd temper those expectations. Again, that we continue to hear this expectation for it to pick up and largely haven't seen it. Now, on a year-to-date basis, direct lending volumes, both sponsored and non-sponsor, are running slightly below the pace of 2024, but I'd say sort of generally consistent from last year. If you look at the use of proceeds for these loans that were actually originated, you can see that clear slowdown in M&A activity. That's the darker blue bars here in the second quarter. In addition, we've seen slower but continued use of dividend recaps. Sponsors continue to find ways to generate some liquidity from investors in this constrained exit environment. And we've seen consistency in refinancing volumes, especially as borrowers tap both direct lending and syndicated loan markets, and there's this push-pull between them, driving spreads a little bit lower now. To further highlight this competition between the two markets, you can see this more clearly in the mega buyout or large buyout space. This is global leverage buyout volumes, and you can see direct lending's captured about 50% of it, just under that for the year-to-date basis. Really, the benefit here is there was sort of a 2-week period after Liberation Day where there wasn't a single broadly syndicated loan issued in the U.S. It's the longest stretch of inactivity since 2020. And private credit was able to step in and take advantage of some of those deals. So you can kind of see that here in this chart. Again, this highlights that continued push-pull competition we see. I don't think that's going to subside anytime soon. Borrowers have pros and cons to consider between both markets. So again, I think there's a use case for both. Now, if you turn to some of the risks, some of the metrics we're monitoring closely for credit deterioration, those two metrics are PIK interest levels and non-accruals. I've talked previously about how I don't think PIK interest is a particularly strong indicator of the presence of credit stress, really with the presence of PIK toggles for large but healthy borrowers. So PIK remains elevated versus long-term averages, but again, I think a lot of that can be ascribed to that dynamic that's formed in the middle and upper middle market increasingly. Again, it's above average, but I don't think it's at a level that indicates major concerns right now. And importantly, if you look at the light blue line here, this is non-accruals, deals that aren't paying interest and are at risk of default. There's some borrowers that are under pressure, but it's well below long-term averages. And again, I don't see there's a lot of signs of building credit risk from a fundamental standpoint. Just to wrap things up on opportunities and risks, I'll start with interest rates. It's a bit of a double-edged sword here. The administration's clearly pushing for the Fed to cut rates, and there's a clear push-pull battle between the Fed chair and the president right now. We'll see what happens. Lower rates provides additional relief to borrowers. That's a good thing. In turn, for lenders and investors in the asset class, that reduces the all-in yields you can earn. If we do see some increased uncertainty, I would expect spreads to widen. They sort of stabilized around the SOFR plus 500 basis point mark right now. But again, any uncertainty or ability to sort of step in when syndicated markets step back, I think you can see some spread widening from here. It's clear competition remains. There's pros and cons for both. But again, I think a lot more borrowers are valuing the speed and certainty of execution that private credit offers. And it's shown through in some of the data more recently that I touched on. On the risk side, I'll just touch on default risk. That's obviously the primary concern in credit always. We're monitoring for credit quality and some of these metrics to show increased credit concerns. But again, haven't seen that materialize largely. I'll just sum it all up. While there's definitely risks that we're monitoring, you have to give some credit to those credit managers for doing well in your portfolio this year.
Thanks, Chad. And private credit is something that, as a firm and in the institutional world, we've really seen it gain a lot of momentum over the last 5 years or so. And I think this lays out a lot of the reasons why it continues to be a part of portfolios, and it will probably occupy larger parts of portfolios for some clients as well. So that lands us here at the end of materials. And as of about 2 minutes ago, we have not received any other questions. Claire, I'll pause here. If there are any, go ahead and throw them out there. If we received any, if not, we can wrap up.
Still nothing.
Okay, so if you do have follow-up questions, you can reach any of us who spoke today. You can find our contact information earlier here in the deck as well as on our website. But thank you for spending the last hour with us. The second quarter was one that we won't forget. Whether that's for good reasons or bad reasons, it's probably up to individuals to decide for themselves. But thank you for spending some time with us. We hope it's been a good use of your time, and we'll see you all next time. Thank you.